Welcome back to the deep dive. This week, we're looking at some really fascinating and pretty impactful shifts in the crypto market. Our mission, as always, is to give you that concise, high-level business briefing. We're distilling the critical developments from quite a few sources. We're covering regulatory news, corporate finance moves, market innovations, the whole picture. The idea is to give you a clear synthesis, a shortcut to being well-informed on this fast-moving sector. Think game-changing regulations, big companies making crypto plays, how global finance is adapting. Yeah, we've got you covered. Okay, so let's unpack this first one right away. There's a really significant development coming out of the U.S. regulatory scene. The CFTC, the Commodity Futures Trading Commission, is basically clearing a path. It could fundamentally change how Americans interact with offshore crypto exchanges. It's part of their Crypto Sprint initiative, and they've announced a pathway for these exchanges to serve U.S. customers legally. They register under something called the Foreign Board of Trade Framework, or FBOT. So what does this move actually signify? Is it just red tape changing?
Well, it's fascinating because it's really not just a bureaucratic tweak, If you zoom out a bit, this looks like a direct response to the policy from the previous Trump administration. The goal was to strengthen U.S. leadership in digital financial technology, making the U.S. more welcoming. And the interim CFTC director, Caroline Pham, she put it pretty clearly. She said, "Today, the CFTC welcomes Americans back, opening up the U.S. market to the world." So the aim is to reverse that trend we saw, where crypto firms were actually leaving the U.S. between 2021 and 2024. A lot of that was down to regulatory uncertainty, that kind of walled garden feel.
Right, the walled garden. So if the CFTC is kind of rolling out the welcome mat, what are the immediate benefits for, say, the average U.S. crypto user? What changes for them?
For you, the listener, this is potentially huge. The main goal here is to seriously boost liquidity in the crypto market. It takes down those barriers that, restricted U.S. residents to just a handful of domestic options. Think about it before. Maybe you only had access to Binance.us, which isn't even the same as global Binance and isn't everywhere in the U.S. either. This opens things up. More choice, potentially better prices. That's what a healthy market needs.
And the idea, like you said, is reducing the legal headaches for crypto companies, hoping to spur innovation here while still, trying to protect market participants. But it does raise a big question. How does this affect the competition between the U.S. platforms and the international ones? Is it like one wins, one loses, or does everyone benefit? And where does innovation end up settling long term?
That's a really critical point. We're almost certainly going to see more competition, which generally is good for users, right? U.S.-based platforms will have to step up their game, innovate faster to keep their share. Meanwhile, those offshore exchanges suddenly get access to this massive market they were locked out of. The hope, I think, is that this regulatory clarity brings talent and capital back to the U.S. So innovation in digital finance doesn't just drift away elsewhere. It's about keeping the U.S. a leader, not just playing catch-up.
Makes sense. So while the regulators are opening doors, we're seeing this other big shift in how traditional companies are actually using crypto, specifically putting Bitcoin on their balance sheets. And this is where it gets really compelling, I think. K33 Research is reporting a near doubling of public companies holding Bitcoin just in the first half of 2025. Went from 70 to 134 companies, and together they hold what? Almost 245,000 Bitcoin? That's huge. People are comparing it to when companies started holding gold, finding new ways to get exposure. But is this always a smart strategic move? Or is it sometimes, maybe, a bit desperate, a short-term boost?
Yeah, putting it in context. While many companies are strategically getting into digital assets, it's really crucial for you, as someone learning about this space, to tell a difference. Is it a genuine long-term strategy, or is it more of a short-term promotional tactic? We've definitely seen some cautionary tales. Remember Windtree Therapeutics? They announced a $60 million B&B treasury plan. Stock popped briefly, sure, but then it crashed like over 90%. And then they got delisted by NASDAQ because the stock price was too low. It really highlights the massive risks if the strategy isn't solid.
Wow, yeah, that's a stark example. So for someone watching these companies, maybe a business leader or an investor, how do you spot the difference? How do you tell a real strategy from just a risky gamble disguised as innovation? What are the signs?
Well, Mike Foy, he's the CFO at Amunet Bank, he gave some pretty clear indicators. He suggests looking at management's appetite for risk, their leverage levels. Are they still focused on their main business? And are insiders selling stock? If any of those things feel off, maybe management's taking on way too much risk for something outside their core area, or insiders are cashing out while hyping crypto buys, that could signal it's more about pumping the stock short-term than a real long-term plan for the company's health. Beyond just those signals, though, you need to grasp the intent. Is the company adding Bitcoin as a long-term treasury asset, diversifying like MicroStrategy? Or is it a struggling company trying anything for a narrative boost, that sort of crypto halo effect? We're seeing a divergence, established tech firms using crypto for future stuff, interoperability, and then smaller, maybe riskier firms just chasing the hype for their stock.
That's really useful advice for spotting those red flags and understanding the why behind it. And then on the flip side, you mentioned MicroStrategy. Michael Saylor's company, they're almost the poster child for corporate Bitcoin buying, right? They now hold, what is it, 629,376 Bitcoin, valued over $72 billion. And they're up over 56% on that. What's their strategy? What makes them different from those cautionary tales?
MicroStrategy's approach is very distinct. Saylor's whole philosophy is that Bitcoin is a better treasury reserve asset, a hedge against inflation, currency issues, long-term store of value. That's his core belief. And what's interesting is how they buy. They typically do large OTC deals over the counter, so private agreements, off the regular exchanges. They do this specifically to avoid impacting the market price when they buy huge amounts. That's a sophisticated institutional move. It really sets their long-term holding strategy apart from short-term speculation. Totally different playbook. And it's not just Bitcoin anymore. Companies are also starting to look at Ethereum, ETH, and other altcoins for their treasuries. Often it's about potential staking rewards, earning yield, or maybe collaboration opportunities with blockchain foundations. Ray Youssef from Noonies, he described Ethereum as kind of a hybrid tech stock and digital currency because it has that asset value, but also the utility of a tech platform. So for you, the investor, watching all these different corporate moves, it really hammers home the need for due diligence.
You have to understand the real motivation when a company adds crypto to its books. Not all crypto adoption is the same.
That's a crucial distinction. Genuine strategy versus speculation. And this growing comfort level institutionally isn't just happening in corporate treasuries. It's mirrored, maybe even amplified, by another huge trend bringing crypto more mainstream. The explosion of ETFs, exchange-traded funds. And yeah, it's not just Bitcoin ETFs anymore. The market's diversifying fast.
Exactly. Just this week, actually, RX Osprey filed with the SEC for a BNB staking ETF. VanEck filed for something similar not long ago. This ETF plans to put at least 80% of its money into BNB. And the key part is it plans to stake that BNB, essentially lock it up to help run the network and in return get rewards, like earning interest. They're estimating yields around 1.5% to 3% a year from that. And they manage it carefully, making sure the staked or illiquid assets stay below 15% of the whole portfolio. That 15% rule is a standard regulatory thing and makes sure investors can always get their money out, redeem their shares, even if some assets are locked in staking. Anchorage Digital Bank is lined up to be the custodian for this one.
Okay, that's a good explanation of how these staking ETFs work and the safety nets. But how are these new types of funds actually doing in the market overall? What are the trading volumes like?
Oh, the market activity data is incredibly strong. It really tells a story about mainstream acceptance picking up speed. So Value.com data shows really consistent, strong activity in crypto ETFs. Bitcoin ETFs, for instance, pulled in around $3 billion in inflows in April, then jumped to $6 billion in July. Ethereum ETFs also saw big numbers, $5.4 billion in July, $3.7 billion in August. And get this, the combined trading volumes for both Bitcoin and Ethereum ETFs hit an all-time high in mid-August. Ethereum ETFs alone traded about $17 billion. That's just a record-shattering figure.
Wow, $17 billion for ETFs. Those numbers are definitely staggering. So, okay, they provide easier investment access, but what else does this boom in ETFs, the number of them, the trading volume, what does it signal about the crypto market overall? Is it just about access?
It signals much more than just access. It points to a significant maturing of the market infrastructure. And yeah, growing mainstream acceptance. It provides that regulated on-ramp for a much broader range of investors, people who maybe don't want the hassle of wallets and keys. And putting this in perspective, this trend fits perfectly with more crypto companies deciding to go public themselves, like Griffin Digital Mining stock. It surged, 231%, just anticipating its merger in September with American Bitcoin?
Yeah.
And that's a company linked to the Trump family.
That's a massive jump. And it feels like part of a bigger pattern we're seeing, right?
Absolutely. We saw Circle go public in June, bullish in August, and there are rumors about Gemini and Kraken possibly doing the same. All this is happening against the backdrop of that broader U.S. policy shift towards digital assets, including laws like the Genius Act for stablecoins. And for anyone watching for altcoin season, when smaller coins take off, Bitfinex analysts are suggesting that big altcoin surges really depend on getting more U.S. crypto ETF approvals. Right now, Solana, SOL, that political meme coined official Trump, and SUI, SUI, all have ETF applications pending. It just highlights how crucial that regulated access point is for the whole market.
Okay, finally, let's switch gears slightly to stablecoins. Coinbase just put out a really bold prediction about their future and their role in global finance. They're projecting the market for dollar-pegged stablecoins could reach a massive $1.2 trillion by 2028.
Yeah, what's fascinating there is just the sheer scale of that prediction and the potential economic ripples. They believe this huge growth will be largely driven by comprehensive U.S. stablecoin regulation actually coming into effect. Specifically, that Genius Act, which is slated for January 2027. Now, stablecoin issuers, they usually back their coins with things like short-term U.S. Treasury bills, right? So Coinbase estimates that this kind of growth would mean the U.S. Treasury needs to issue an extra $5.3 billion in T-bills every week. But interestingly, they predict this will only cause a slight temporary dip in 3-month T-bill yields, like 4.5 basis points. Not the major market disruption some people were worried about.
That's a very specific forecast. So stepping back, what's the wider implication of this huge growing demand for stablecoins for global finance, international relations?
Well, to put it in perspective, stablecoins, especially from private companies like Tether and Circle, are already huge buyers of U.S. Treasuries. They hold more U.S. debt than some entire countries do. This growing influence isn't just a financial market thing. It's actually sparking a global competitive reaction. It's kind of a quiet but really profound geopolitical shift happening in the background, written in code. You see countries like South Korea, their Financial Services Commission is drafting stablecoin laws right now, aiming for October. Even China is reportedly thinking about allowing yuan-based stablecoins in certain economic zones, maybe for international trade. They're all looking to legitimize their own digital currencies. Why? Well, partly for domestic reasons, but also to compete with the U.S. dollar in this new digital age. It's either a direct challenge or maybe a defense against the dollar's dominance.
That's a really compelling angle, that implicit competition between nations. So how do you see this accelerating stablecoin landscape pushed by private companies and national strategies? How will it keep integrating with and maybe reshaping traditional finance and the crypto world?
I think it's going to be a very dynamic two-way interaction. We'll probably see more traditional banks and financial firms adopting stablecoin rails for payments. Faster, cheaper cross-border transactions, maybe skipping the old slow systems like SWIFT. But on the other side, the sheer amount of T-bills backing these stablecoins will tie the crypto market even closer to sovereign debt markets. That gives crypto firms, indirectly at least, a bigger seat at the table when it comes to traditional monetary conditions. This convergence forces both sides to adapt. It's creating new financial products, new regulatory puzzles. This could really define the next decade of global finance.
What an incredible deep dive this week. Really covered a lot of ground. We've unpacked these big regulatory shifts opening up U.S. access, the corporate adoption strategies, both smart and maybe speculative, the booming ETF market, and this projected trillion-dollar future for stablecoins that could reshape global finance.
Yeah, given all these rapid shifts, regulation, corporate moves, global interest, what does this week really tell us about that long-term merging of traditional finance and the decentralized world? And maybe what's the next big frontier for innovation as these forces collide? Will it be more tokenization of real-world assets, maybe entirely new forms of digital ID, or perhaps a completely different global payment system altogether? Lots to think about. We really encourage you to keep exploring, keep asking those questions, and definitely stay informed.